Imagine a silent, empty glass office overlooking the heart of Manhattan. The sun reflects off the polished floor, illuminating rows of desks that once buzzed with the energy of 1,000 dreams. There are no keyboards clicking and no voices debating the future of the world. There is only the stillness of a multi-billion-dollar tomb. In the center of this silence lies a number that continues to haunt the history of modern finance. That number is $47 billion. This was not a debt, and it was not a projected profit. It was a valuation. It was the amount of money the world decided a single company was worth, only to watch that entire mountain of wealth vanish into thin air in less than 90 days. This is the story of how a company that rented office space convinced the most sophisticated investors on the planet that it was actually a mystical tech empire. It is the story of the rise and spectacular fall of WeWork. The year was 2019, and the world of high finance was under the spell of a single man named Adam Neumann. Adam was not your typical corporate executive. He was tall, charismatic, and spoke with the fervor of a religious prophet. Alongside him stood the massive financial might of SoftBank, an investment giant led by Masayoshi's son. Together, they planned to launch an initial public offering that would cement WeWork as the king of the new economy. But instead of a victory lap, the launch became a disaster that Wall Street would never forget. To understand how we got there, we have to look past the marketing and look at the moment the facade began to crumble. This collapse did not start with a stock market crash or a scandal. It started with a document known as the S-1. In the world of investing, an S-1 is a mandatory filing that a company must release before it goes public. It is supposed to be a sober, factual report filled with spreadsheets, risks, and hard data. But when WeWork released its S-1 in August of 2019, it read less like a financial report and more like a corporate suicide note written in the language of a New Age cult. The very first page was not dedicated to shareholders or profits. Instead, it was dedicated to the energy of we. The document claimed the mission of the company was to elevate the world's consciousness. For the analysts on Wall Street who were used to looking at profit margins and revenue growth, this was the first red flag in a long line of warnings. There was a profound gap between the vision Adam Neumann sold and the reality of the business he ran. The vision was a global community that would change how humans interacted forever. The reality, however, was much simpler. WeWork was a real estate company. They would sign long-term leases for office buildings, put in some trendy furniture, add a few glass walls, and then rent out individual desks or small offices to freelancers and startups on a short-term basis. It was a classic model of real estate arbitrage. They took a long-term risk and hoped to fill it with short-term customers. But Adam Neumann insisted that WeWork was not a real estate company. He argued it was a tech company, a platform, a physical social network. He used terms like space as a service to justify a valuation that was many times higher than any traditional property firm. This myth-making phase was essential to the company's growth. Adam spoke about the we generation. He sold a lifestyle where work and life were blurred, where free beer on tap and neon signs saying "do what you love" were the cure for modern loneliness. This storytelling was incredibly effective. By using technology terminology to describe physical chairs and tables, he managed to bypass the usual skepticism of investors. He was not just selling a desk, he was selling an identity. The true inflection point for the company came when Adam met Masayoshi's son, the head of SoftBank. Their legendary first meeting reportedly lasted only 12 minutes. In that short window, Adam managed to charm one of the most powerful investors in the world. Masayoshi's son did not ask for a detailed business plan or a path to profitability. Instead, he told Adam that he liked him, but that he was not being crazy enough. Son's instruction was simple: be crazier. He backed this up with billions of dollars in capital. This was an injection of cash based entirely on vibes rather than spreadsheets. With SoftBank's bankroll, WeWork began to grow at a terrifying speed, opening new locations in cities all over the globe, even when the math suggested they were losing money on every single one. But while the world saw a unicorn and a visionary leader, the balance sheet saw a black hole. And that is where everything changed. As the company expanded, it was burning through cash at an unsustainable rate. Every new office they opened added more weight to a structure that was already leaning. The psychology of the pitch kept the dream alive for years. Elite investors from firms like JP Morgan and Benchmark fell into the trap of founder worship. They were captivated by Adam's personality and his ability to command a room. In a financial environment defined by low interest rates, investors were desperate for the next big thing. They were willing to suspend their disbelief because they were terrified of missing out on the next Amazon or Google. Before we continue, subscribe to the channel and tell us in the comments where you are watching from. They chose to believe the story because the story was more exciting than the truth. They ignored the fact that the company had no clear way to ever become profitable. They looked past the bizarre behavior of the chief executive officer because they thought his eccentricity was the secret sauce of his genius. But as the date for the initial public offering approached, the cold reality of the public market began to clash with the fever dream of the private investors. The world was about to see what happens when a $47 billion story finally runs out of pages to turn. The financial wizardry that allowed this $47 billion valuation to exist was built on a foundation of what critics now call fake math. To hide the massive holes in their balance sheet, WeWork invented its own financial metric. They called it Community-Adjusted EBITDA. In the traditional world of accounting, EBITDA stands for earnings before interest, taxes, depreciation, and amortization. It is a standard way to measure the raw profitability of a business. But Adam Neumann and his team decided that the standard rules did not apply to them. Their community-adjusted version took out the most fundamental costs of doing business. They excluded the cost of rent for their locations, the cost of utilities, and the marketing expenses required to find new members. By removing these massive expenses, they could pretend that a company losing hundreds of millions of dollars was actually performing quite well. It was a mathematical illusion designed to keep the narrative moving forward. This illusion was necessary because of the tech veneer Adam Neumann had carefully painted over the company. In the investment world, a traditional real estate company is usually valued at about 2 times its yearly revenue. This is because real estate is slow, expensive to maintain, and difficult to scale. However, a high-growth software company can be valued at 20 times its revenue, or even more. Adam knew that if WeWork was viewed as a landlord, its valuation would never reach the heights he desired. So, he reskinned the physical office space as a digital platform. He claimed that the desks were not furniture, but hardware. He argued that the community of members was a physical social network with data and engagement that rivaled companies like Facebook or Google. This branding was the key to unlocking the billions of dollars from investors who were looking for the next digital revolution rather than another property management firm. While the promotional videos for WeWork were sleek, high energy, and filled with smiling young entrepreneurs, the actual numbers told a story of absolute destruction. In 2018, the company was losing money at a rate that is difficult to even comprehend. They were losing $219,000 every single hour of every single day. For every dollar they brought in, they were spending nearly $2. Most businesses would have folded under that pressure, but because of the constant flow of capital from SoftBank and other elite firms, WeWork was able to ignore the gravity of their financial reality. They were trapped in a cycle where they needed to grow as fast as possible to justify their valuation, but every new lease they signed and every new building they opened only increased their hourly losses. The lack of oversight was not just limited to the accounting. The governance failures at WeWork were some of the most shocking in modern corporate history. This was a period defined by extreme self-dealing. Adam Neumann used the company as a personal bank account. In one of the most infamous examples, he trademarked the word "we" and then charged his own company nearly $6 million to use the name. He also purchased buildings himself and then leased them back to WeWork, effectively acting as both the landlord and the tenant. He was making money from the company on both ends, while the investors were the ones taking all the risk. There was no board of directors strong enough to tell him no. His voting power was absolute, meaning he could make decisions without any accountability to the people who were actually providing the billions of dollars in funding. All of this came to a head when the S-1 document was finally released to the public. This was the moment of revelation. Before this, only a small group of private investors knew the truth. When the document hit the public market, it was viewed as a document of madness. Analysts and journalists began to tear through the pages, finding the bizarre self-dealing and the community-adjusted math. The realization hit Wall Street like a physical blow. The emperor had no clothes, there was no profit in sight, and the leader of the company appeared to be more interested in his own wealth and his own ego than the stability of the business. Within days, the excitement for the initial public offering turned into a wave of mockery and fear. If the world's smartest investors could be fooled by a story this transparent, what does that say about the system itself? We will look at the fallout in a moment, but first, we must understand the inversion at the heart of the WeWork story. The part most people miss is that the rapid growth was not a sign of a healthy company. It was actually the mechanism of its collapse. In a normal business, growing means you are finding more customers and becoming more efficient. But for WeWork, the growth was artificial. They were buying their revenue by spending more on marketing and rent than they could ever hope to recover from their members. The faster they grew, the faster they died. They were a plane that was flying at top speed while its engines were on fire, and the only thing keeping them in the air was the constant injection of fuel from Masayoshi's son. The contrast between the leader and the workers was becoming impossible to ignore. While Adam Neumann traveled the world in a $60 million private Gulfstream jet, his employees were working in a high-pressure environment defined by mandatory Sunday meetings and a culture that demanded total devotion. These employees were often paid less than the market rate because they were given stock options that Adam promised would one day make them all millionaires. They believed in the mission of elevating the world's consciousness because they trusted their leader. They were the ones on the ground, making sure the free beer was cold and the desks were clean, while Adam was surfing in the Maldives or hosting lavish parties. The reality of the We generation was that it only truly benefited the man at the very top. As the valuation began to plummet from $47 billion toward the floor, the people who stood to lose the most were not the billionaire investors, but the thousands of workers who had tied their future to a dream that was rapidly turning into a nightmare. The stage was set for a total collapse, and the world was watching in real time as the most hyped startup in history began to fall apart. The speed of the unraveling was unlike anything Wall Street had ever seen. In a matter of weeks, the $47 billion valuation did not just decline, it disintegrated. The initial public offering, which was meant to be the crowning achievement of the decade, was indefinitely postponed. Public investors, unlike the private venture capitalists who had fueled the fire, looked at the numbers and saw a house of cards. They saw a company that was burning through cash with no path to profitability. As the interest from the public market vanished, so did the company's lifeline. Without an initial public offering to bring in new capital, the bankruptcy was no longer a distant threat. It was an immediate reality. The board of directors, which had once been a mere audience for the performance of Adam Neumann, was forced to act. They could no longer ignore the toxic combination of the founder's erratic behavior and the collapsing finances. In September of 2019, the messianic leader was finally forced to step down as the chief executive officer. The man who wanted to live forever and become the first trillionaire was stripped of his power. But the story of his departure was perhaps the most bitter pill for the public to swallow. While the company was laying off thousands of employees and the value of their stock options was being wiped out, Adam Neumann negotiated an exit package that defied logic. This was the ultimate irony of the WeWork saga. For his failure to take the company public and for the near destruction of the business, he was given what became known as a golden parachute worth approximately $1.7 billion. This included a $500 million credit line and a massive consulting fee. Meanwhile, the people who had worked 60-hour weeks and spent their weekends in the office were left with nothing. They had been told they were part of a revolution, but when the revolution failed, only the general was allowed to leave with the treasure. This disparity became a symbol of everything that was wrong with the startup culture of the era. The fall of WeWork marked the definitive end of the growth at all costs era in Silicon Valley. For years, investors had been willing to ignore losses as long as the revenue numbers were moving up and to the right. They followed the playbook established by companies like Amazon and Uber, believing that market dominance would eventually lead to profit. But WeWork proved that some models simply do not scale. It forced a fundamental shift in how startups were evaluated. Suddenly, the term unit economics became the most important phrase in the room. Investors stopped asking how many new cities a company was in and started asking how much profit each individual transaction generated. The era of founder worship began to fade, replaced by a new demand for governance, transparency, and adult supervision. The entire venture capital ecosystem had to recalibrate its appetite for risk. This event served as a masterclass in the invisible mechanism that separates the private and public markets. In the private market, a company's value is often whatever the last investor is willing to pay. Masayoshi Son and SoftBank could decide that WeWork was worth $47 billion because they had the capital to make it a reality on paper. They were playing a game of chicken with reality, hoping that by the time they needed to sell to the public, the reality would have caught up with the narrative. But the public market is a different beast entirely. It is a place where hundreds of thousands of independent analysts and fund managers look at the hard data. When WeWork tried to make the jump from the private bubble to the public stage, the disconnect was too large to ignore. It was a stark reminder that belief can inflate a bubble, but only math can sustain it. The fallout continued as the company eventually spiraled toward bankruptcy. The grand vision of elevating the world's consciousness was replaced by the cold reality of liquidators and restructuring experts. J.P. Morgan and other elite investors had to explain to their clients how they had been blinded by a story that lacked a foundation. The lessons were painful and expensive. It became clear that when governance fails, the story is the only thing left, and a story cannot pay the rent. The collapse of WeWork was the ultimate case study of what happens when the private market and the public market finally collide. Looking back, this was not just a failure of a startup. It was the commodification of belief. Adam Neumann was not just selling office space. He was selling a sense of belonging in a world that felt increasingly lonely. He used the language of community to build a real estate empire, and for a while, it worked because people wanted to believe that their work could have a higher purpose. Today, as you stand in one of the many quiet, defunct office spaces that once buzzed with the energy of the We generation, the ego of the project becomes clear. The neon signs that once glowed with the words, "Do what you love," are now dark, their glass tubes cold and empty. It is a meditation on the fragility of hype and the cold, mathematical reality of time and capital. We didn't just buy into a company. We bought into a charismatic man who promised us a community we were already losing. The story worked until it didn't. But the most dangerous part of this entire saga is the knowledge that right now, we are likely already looking for the next charismatic visionary and the next impossible dream to believe in.